Değerli misafirlerimiz, Sayın Başkan Yardımcım, hepinizin bildiği gibi ekonomi literatürü ve ekonomi yazını temel olarak rasyonelite varsayımı üzerinde çok fazla kurgulanmış durumdaydı. Özellikle son 100 yıl diyebiliriz. Hani adını şu an davranışsal finans diye adlandırabileceğimiz ekonominin alt bilim dalı ve behavioral finance, behavioral economics diyebileceğimiz alt bilim dalı bu rasyonelite varsayımının artık doğru olmadığını, bizim hani tırnak içerisinde normal insanlar olduğumuzu, yanlış kararlar alabileceğimizi, bazı varsayımları ihlal edebileceğimizi bir sürü deneyle, bir sürü olayla gözler önüne serdi. Özellikle yaşadığımız son finansal krizde hani gerek çok büyük CEO'ların, menajerlerin, yöneticilerin çok büyük hatalar yaptıklarını gördük. Hatta bu hataların niye yapıldığı sorulduğu zaman hani müziğin çaldığı yerde dans etmeyi durduramazdık gibi hani komik cevaplar verenler oldu. Yani herkes veriyordu, biz de verdik bu kredileri gibi cevaplar verenler oldu. Bunlardan bu söylediğim cevap veren Citibank grubun CEO'su Chuck Terrance. Dolayısıyla bu rasyonelite varsayımının ihlal edildiğini çok fazla görmeye başladık. Bu krizde bize bu varsayımın doğru olmadığını çok fazlasıyla ispat etmiş oldu. Şimdi davranışsal finans alanında çok önemli bir misafirimiz var. Kendisi bu alanda birçok çalışmasıyla tanınıyor. Hani bazı çalışmalarına 3000-4000 atıf almış bir insan. Gerek kendisinin gerek bu alanda bir çalışan bilim adamları artık hani beyindeki iletim mekanizmalarının nasıl karar almayı etkilediğine dair çok önemli çalışmaları var. Yani hani artık tıbba falan kadar girdi finanstaki karar alma mekanizmalarının nasıl çalıştığı. Bir sürü doktor, yani bildiğimiz manada tıp doktoru bu konu üzerine çalışıyorlar. Neuroscience diye bir şey çıktı. Şimdi bunların hepsi ekonomi ve finans yazılımını çok fazla etkilemeye başladılar. Size bu konudaki en önemli misafir, dünyadaki en önemli insanlardan bir tanesini misafir olarak bize de size de hep beraber çağırdık. Sağ olsun kendisi teklifimizi kabul etti. 6 aydır falan yazışıyoruz. Kendisinin undergrad'ı Terrance Odean, undergrad'ı istatistik, master'da finansta çalışmış ve doktora da finansta çalıştı. Hepsi Berkeley'den. Daha sonra UC Davis'e geçmiş iş çalışması olarak, yani orada işe başlamış. Tekrar Berkeley'e geri döndü. Şu an University of California, Berkeley'de davranışsal finans çalışmaları yapıyor. Çok önemli paper'ları var, çok önemli bulguları var. Bir tanesi mesela benim çok dikkatimi çekmiş bir tanesiydi. Çok fazla trade edenlerin, çok fazla alım satım yapanların çok fazla zarar ettiğine dair bir bulgusu var. Çok enteresan bir bulgu. Bizi çok ilgilendiriyor çünkü Türkler çok fazla alım satım yapıyorlar yabancılara kıyasla. Kendisine çok teşekkür ediyoruz hepinizin huzurunda. Thank you very much for accepting our offer and coming to Istanbul. So we are proud to host you here and the floor is yours. Thank you.
Thank you. Benjamin Graham once said that the investor's chief problem, even his worst enemy, is likely to be himself. I'm going to spend most of the next hour talking about things that individual investors do that make them their own worst enemies when it comes to investing. But first, I wanted to talk to you about why I think finance is harder than accounting. Are there any accountants here? Not a single accountant. All right. Well, the reason I think that finance is harder than accounting is that to be an accountant, to understand accounting, you have to be able to add and subtract. You have to be able to deal with quantities. And human beings have a good intuitive grasp of quantities. However, to really understand finance, you have to understand probability. And human beings actually don't have such a good intuitive grasp of probability. And so we end up using a lot of heuristics or rules of thumbs or sort of mental shortcuts to deal with probabilities. Okay, I'll show you what I mean. I hope. Okay, let's see if we can get this to work. There we go. All right, 2 plus 2. Everybody knows what 2 plus 2 is, right? Little children know what 2 plus 2 is. There are occasional exceptions. For example, these days, if you ask an accountant what's 2 plus 2, he's likely to reply, what do you need it to be? But most of us would agree 2 plus 2 is 4. Okay? Simple addition problem. Now how about a simple probability problem? If I flip 2 coins, what's the probability that both coins come up heads? How many of you are pretty sure you know the answer to that? All right. Good. So the probability is 25%. Okay? Now, I'm going to make both problems a little bit harder. 2 plus 2 plus 2 plus 2 plus 2. Did anyone get it? Yeah. You just look at it. I don't even see anyone. You just look. 8 apples. Okay? It's easy. What if I make the probability problem a little harder? Instead of flipping 2 coins, I'm going to flip 4 coins. That, by the way, is the technical high point of this talk. It took me 3 hours to figure out how to flip the coins on the screen. Okay. If I flip 4 coins, what's the probability that any 3 come up heads? I don't care about the order, and the other one comes up tails. How many of you are sure you know the answer to that? No? You have... What do you think the probability is?
0.20 and 5 to the power. Half and 4 to the power. I'm sorry. 1/2, 4 to the power.
To the 4th power. Oh, that would be 1 out of 16. Which in this case, actually, it's also 1 out of 4. It's 1 out of 16 if the order matters. But if you don't care about the order, it's only 1 out of 4. But my point, we're not going to have a lecture on statistics today. Or probability, and I'm not going to talk about permutations. My point is, it doesn't come to us easily. Okay? If you haven't studied this, and probably studied it recently, you don't know what the probability is. And people don't approximate. It's not that they guess and tend to guess correctly. I ran an informal study, and I found that people, their guesses were all over the place. They didn't converge on the right answer. So we tend to have a good intuitive grasp of quantities, but not of probabilities. And as I mentioned before, we use a lot of sort of mental shortcuts to assess probabilities. I'll give an example. Try to think of a company that went public in the United States, say, within the last 10 years, but not the last 5 years. Now, I realize that this question is easier when you live in the States, but perhaps some of you thought of this company. That's what most of my students end up saying. Oh, what about Google? Now try to think of a company that went public. So first to think of a company that went public that was successful, and people think of Google. And if I ask them to think of a company that was unsuccessful, mostly people have a difficult time thinking of the ones that were unsuccessful. So most investors, most of my students, when I poll them, they can easily remember very successful companies, but they don't remember the ones that have failed, the ones that have gone bankrupt. And for that reason, they tend to overestimate the likelihood that companies will be successful. So suppose that an individual investor, is thinking of buying a high-tech company during its IPO. And he says to himself, I wonder how often these companies are very successful. And he thinks of Google, and he says, well, that was really successful. And then he thinks about some of the other big companies, Apple and Microsoft, and say, well, those were really successful. And when he then asks himself, well, how often are companies not successful? It's harder to think of examples of companies that went public and then failed. We tend to remember the big, exciting failures like Enron and 3Com, but not companies that just sort of faded away. So this investor, it's quite likely, if he just estimates probabilities by how easily examples come to mind, he will overestimate the likelihood that this company is going to be successful. So it will increase the probability that he buys in the IPO. And most recently, that might result in him calling up his broker and saying, please get me some Facebook stock, because I'm sure Facebook is going to be successful because all these other companies were. Okay, some of you, those of you who studied finance academically, undoubtedly heard of the efficient market hypothesis. Gene Fama, who teaches at the University of Chicago, is one of the big proponents. And Gene described it once. He said that a market in which prices always fully reflect available information is efficient. And this, when I started studying finance back around 1990, this was the dominant paradigm in academic finance. This is what we were taught in the classroom. If you went to a class, you were taught markets are efficient. But not everyone believes that markets are efficient. For example, Warren Buffett, the famous U.S. investor, once said, "I'd be a bum in the street with a tin cup if markets were efficient." So there's some disagreement. So when I think about market efficiency versus, the world of inefficient markets, I often use an analogy to games that people might play when they go to Las Vegas, when they go to a casino. And to me, efficient markets are like the game of roulette. And that's because everyone has the same chance of winning. It's basically a level playing field. If I play roulette, if I put my money on one number, and one of you puts your money on another number, we both have the same chance of winning. So that's one view of markets. Another view, the one to which I personally subscribe, is that markets are more like the game of poker. Okay, now imagine that you were at a casino in Las Vegas, and you went to a room in the back, and there are 10 guys, and it's probably guys, 10 men, playing poker. They're playing Texas Hold'em, which is a very popular poker game. Okay, now they're in the middle of a hand, and you talk to the hostess for a moment. She's waiting to serve drinks, and she says, "Yeah, there are 10 guys here. 7 of them are tourists. They came from Des Moines, Iowa, a farming area in the United States. And they're in Las Vegas for 1 week, and they're playing poker every night. The other 3 people, the other 3 men, are professional poker players who live in Las Vegas and play poker for a living. Who do you think is going to win?" Any one hand, it's probably a tourist who will win, because there are 7 tourists and only 3 professionals. But the tourists will tend to win from each other, not from the professionals. And when the tourists win, they'll win less. And when they lose, they'll tend to lose more. And over the course of the night, and certainly over the course of the week, the money will flow from the tourists to the professional poker players. And to some extent, I think this does happen. This happens in markets. And largely, the tourists in markets are individuals, and the professionals are professionals, professional investors, whether it's people like Goldman Sachs or at Citibank or at a hedge fund or a mutual fund. They tend to have more information and more skill when it comes to investing. Okay, so I'm going to talk today mostly about research that I've done in the behavior of individual investors. So it's going to be, what do we know about investor behavior? I'll then talk a little bit about why does it matter? Why should we care? And then finally, briefly, make some points as to what investors can do. And I guess depending on time, at the very end, I wanted to show you some of the television ads and print ads that have been run in the United States targeted towards investors. Because I think naive investors, inexperienced investors, get an idea as to how they should behave from watching, from the behavior of others, but also from things like watching television. So we'll get to that at the end. So here are the aspects of investor behavior and psychology that I want to discuss today. Confusion of probability, which I think it contributes to under-diversification. Overconfidence, which causes many investors to trade too much. A desire to avoid or reduce regret. which leads people to hold on to losing investments and sell winners. I'll talk about limited attention and how that affects the buying behavior of investors. And then, again, a confusion of probability and tendency to expect the recent past to repeat itself and how that leads investors to chase performance. So let's start briefly with diversification. Probably all of you who've studied financial economics know that most financial economists think that people should hold well-diversified portfolios. Now, I give talks often to financial advisors as well as groups of investors and analysts. And several times during the question and answer period, I've had someone say to me, well, you academicians are always pushing diversification. Bill Gates didn't get to where he is today by diversifying. Most of you probably know Bill Gates was the founder of Microsoft and is one of the world's richest men. And I agree. And I say to them, you're right. If you hold a well-diversified portfolio, you will never be as wealthy as Bill Gates. Of course, if you hold an undiversified portfolio, you will also never be as wealthy as Bill Gates. It's just not going to happen. But you could end up as poor as the Enron employees who lost all of their money when Enron went bankrupt. So 62% of Enron employee retirement savings were in the company's stock. When the company went bankrupt, these people lost their jobs and they lost their life savings. So it's important for people to hold well-diversified portfolios. And I think the biggest reason they don't is, to a large extent, people don't understand the benefits. They don't really understand probability. Okay. Overconfidence causes people to trade too much. In our formal models, in mathematical models of markets, we tend to model overconfidence as agents who think their information is better than it is. But I think more generally what we mean by overconfidence is a belief simply that you have more ability than you do, more ability to deal with information. I teach MBA students, and at the beginning of, when I teach behavioral finance, at the beginning of the semester, I will pass around a questionnaire. And it says, look around the room at the other students who are in the room with you, many of whom you may not know, and rate how good of a driver you think you are compared to these other students. Typically, 25% of my students put themselves in the top 10 percentile. Half the students put themselves in the top quartile, and all but one or two students put themselves above average. Occasionally, I will ask a student who put himself or herself in the middle, why? And my favorite answer came several years ago, where a student said, well, I was going to put myself above average, but I thought about it, and I realized that in the last year, I've gotten 3 speeding tickets, I've caused 2 traffic accidents, and I have to go to traffic court, or else my license is going to be revoked. Maybe I'm just average. So, my students all think they're above average drivers, and I suspect that most investors, especially those who are active in the market, think that they are above average investors. So there are some, in addition to sort of our natural tendency, or many people's natural tendency towards overconfidence, there are also some psychological biases that encourage overconfidence. I wrote a theoretical paper some years ago with my friend Simon Gervais. We wrote about something called self-attribution bias. But basically, it's summed up in an old Wall Street adage that says, don't confuse brains with a bull market. Just because the market is going up doesn't mean you're brilliant. And yet people have this tendency, when they succeed at something, to take credit for the success. And when they fail, they blame bad luck in other people. I do this. I mean, I think we all do this. I write academic papers. I send them to a journal. There's two outcomes. Either the paper gets rejected, the editor says, no, I don't want to publish this paper, or the editor says, I like the paper, make some changes, and I'll probably publish it. When the editor says, I like the paper, I'll probably publish it, I think I wrote a good paper. When the editor says, I don't like the paper, the referee says I shouldn't publish it, I think to myself, the referee is an idiot, and how could I be so unlucky that the editor sent the paper to this person? So I think there's a very strong tendency. So Simone and I, we set up a model in which investors start out not knowing their ability, and they vary in ability. And they infer their ability. They learn about their ability by observing whether they are successful or unsuccessful. But successful investors attribute too much of their success to their ability, and over time they become overconfident. Extrapolating to the real world, we expect that it's probably young, inexperienced, and successful investors that will tend towards overconfidence, or even experienced but very successful investors. And this, by the way, is a bias that I think applies as much to institutional investors as to individual investors. There is a lot of overconfidence among institutional investors, and often it's driven by having had a couple of years of success. It leads to a lot of excessive risk-taking. Overconfident institutional investors are more likely to use leverage, and that tends to get them in trouble. So I wrote another theoretical paper when I was a student, which just looked at how markets are different if investors are overconfident. And what I found that in a market where investors are overconfident, the investors trade more than they would otherwise, they earn less, they tend to under-diversify, because if you're sure you're right, you don't need to hedge yourself. You just can own the thing that you're sure is going to win. And volatility tends to go up in the market. Now, I wanted to test my theory with real data. And I was able to obtain trading records for individual investors at a brokerage firm in the United States. Initially, I got trading records for 10,000 investors. And later, I was able to get a second data set for 78,000 investors. And later, I got other data sets for hundreds of thousands of investors from another brokerage firm. So with the first study, I wanted to show that investors behaved as my theory predicted, that they traded too much. We don't know really how much people should trade, so the metric I used was this. I looked to see when an investor sold one stock and bought another, whether on average the stock the investor bought went on to outperform the one that he sold by enough to cover his trading costs. When you trade, you would like at least most of the time that the stock you buy does better than the one you sold going forward. Well, I looked at this, and to my surprise, I found that the stocks that these people bought went on to underperform the ones they had just sold. And that's before taking out the cost of trading, the commissions that they were paying. Now, I went back and I thought to myself, well, there are reasons to trade besides speculation. For example, somebody might sell a stock because they need money. I have 3 daughters who are in school, in college and graduate school. Maybe if I sell stock, it might be because I need money to help support them or pay their tuitions. Another reason to sell would be for tax purposes. In the U.S., if you sell a stock for a loss, you can reduce your income tax. So I went through the data, and as best I could, I filtered out trades that might have been made for these non-speculative reasons. I only considered cases where somebody sold for a profit, so it wasn't a tax loss sale, and then bought another stock within 3 weeks. So the sale was probably not liquidity driven. When I did that and only looked at speculative trades, to my surprise, these people didn't do better. They actually did worse. Now the stocks they bought went on to underperform the ones they sold by 5 percentage points over the next year. Now, I returned to this same idea that overconfidence was leading investors to trade excessively with a larger data set, 78,000 investors. And I wrote a paper with my friend and colleague, Brad Barber. And we did something fairly simple again. We said, okay, the theory is that overconfident investors will trade more and that will hurt their returns. Let's see whether the most active investors are doing better or worse than the less active investors. So we took all of the investors who were trading common stocks, we divided them into 5 groups based on how actively they were trading, and then we calculated the average annual net return for each group. So the net return means we were taking out the commissions, and our database included commissions, so we knew exactly what they'd paid in commissions. What we found, well, let's see here. The green bars are the turnover activity for each of these 5 groups. And the blue bars are the average annual net return. All of the average returns are high because this particular study was done in the mid and the late 90s. But what's significant is that the buy and hold investors were outperforming the most active investors by a little over 6 percentage points a year. Now, I studied when I was an undergraduate with a psychologist named Daniel Kahneman. And Danny later won the Nobel Prize in economics in 2002. When I showed my results to Daniel Kahneman, he said to me, Terry, it is expensive for these people to have ideas. The more ideas they have, the less money. Now, I did one other study on this topic. An ideal study, if you wanted to show that overconfidence is leading people to trade more and as a result earn less, get lower returns. An ideal study would be to get a large group of investors and separate them into the more overconfident and the less overconfident ones. Now, I didn't have any way of administering psychological tests of overconfidence to the investors in my data set. But based on our anecdotal observation and also reading the psychology literature, Brad and I realized that, on average, men and women differ in their levels of overconfidence. And what surprises some people, but not everyone, is that it's men who tend to be more overconfident, not women. So we thought, okay, on average, men tend to be more overconfident than women, particularly in areas such as finance and the mathematical sciences. Let's separate our group into men and women. And now we have a simple prediction. We expect that men, because they tend to be more overconfident, will trade more actively and that this trading will hurt their returns. We found that men traded 45% more actively than women. Single men traded 67% more actively than single women. For returns, we measured the effect of trading on returns in a very simple way. We looked every year at an investor's portfolio, and we calculated what that investor would have earned if he or she had not traded for an entire year. And then we also looked at what that investor actually earned. And we subtracted the buy and hold return, the do not trade, from the actual return. And that gave us a measure of how much trading was improving or hurting performance. Now, given what I've already told you, it should come as no great surprise to learn that both men and women underperformed a buy and hold approach, but men underperformed by 1 percentage point more a year than women, single men by 1.4 percentage points more a year than single women.
The figures of the trade commissions?
Yes.
So it's net, right?
Net. This is net. And a lot of the effect came from activity, not from the ability to pick stocks, but from just running up higher commissions through trading. Yes. All right. Brad Barber and I did a study of online investing some years ago. I saw this ad in a newspaper, and it said, "Online trading is like the Old West. The slow die first." And it reminded me of the movies I watched as a kid, the Westerns. And in the movies, the guy who can draw his gun first wins the gunfight. Though often by the end of the movie, the gunfighter is no longer alive. In any case, Brad and I, we took a look at people who switched from telephone-based trading to computer-based trading. And this was when online trading was very early. So these were early switchers, people who switched early. And we found that most of these people were doing well before they went online. They started trading more actively after they went online. They started trading more speculatively, and their performance dropped off. Now, there are a lot of things that may contribute to this. One is that we think that many investors simply don't understand transactions costs. And they see, oh, the commission has come down, and they don't understand spreads. They don't understand a lot of the costs of trading. I saw this ad once that reminded me of it. The person on the street says, I lost everything doing online stock trading. And the people walking by say, yeah, but I'll bet he saved a bundle in commissions. All right? The commissions were low, but I lost everything. Another reason that people may trade more online is it's simply easier. It's what if you wake up at 3 o'clock in the morning and you have a great idea about a stock that you want to buy, or more likely at 3 o'clock in the morning you wake up and you're in a panic and you want to sell everything? Would it be a good idea to trade? Let me show you. I'll show you one ad that E-Trade ran some years ago.
It was 2 a.m. It had to be done. Quickly, efficiently. You were out to make a killing. So you placed an order for that fast-moving stock you were watching without waking your baby or your broker. Thanks to E-Trade, where you can get...
Yeah, so E-Trade says, wouldn't it be great to be able to trade at 2 in the morning? I think it's better to go back to sleep. Right? Go back to sleep, wait till the morning, have a cup of coffee or a cup of tea, talk to your spouse, read the paper, and then ask yourself, do I really want to sell everything? So sometimes if you make something too easy, it's not necessarily in people's best interest. Okay, in any case, what did we find? So what we have here in the blue line on this graph is other investors who had similar size portfolios but didn't switch to computer-based trading. And these are the people who switched. And it's all lined up in event time. So this is the month in which the people in the red switched. And this is the trading activity. And we see that the people who switched to online trading were more active traders to begin with. They traded very actively for a couple of months. And then they settled down. And when they settled down to a higher rate of trading than they had before they made the switch. As far as performance goes, what this is this is now only the people who made the switch. The red is gross returns. The green is net returns. And we see they were doing quite well to begin with. Afterwards, their gross returns were about average, and their net returns were negative. Well, market-adjusted returns. These are market-adjusted returns. Their market-adjusted returns were negative. You might look at this and say, wow, they had some skill and they lost it. I don't think that's what's going on. I think that from any large group of investors, there are going to be some who are doing well in some period. And those were the ones who were more likely to try out the new technology when it came. And after they made the switch, their luck was about average. Okay. People tend to hold on to their losing investments and sell their winners. I'll show you some evidence in a moment. I've done a couple of papers on this. Many other people have looked at it also. But the question is why? And I think the reason is this. If you buy a stock and you sell it for a profit, how do you feel? You feel good, don't you? Most people feel good about that. And if you buy a stock and you sell it for a loss, how do you feel? Not so good, right? You feel bad. So The obvious solution is just buy stocks that are going to go up. It's not that easy, right? But you just buy stocks that are going to go up, but investors don't know how to do that. But what they do know how to do is very simple. If an investor owns stocks, and a couple of them have gone up and a couple have gone down, and he or she needs to raise money, maybe to buy something else or maybe for other purposes, he's more likely to sell the one he can sell for a gain and feel good. And hold on to the loser and say, oh, it's only a paper loss. It's going to come back. I just have to wait a little while. So investors, they postpone the regret of selling for a loss. And they accelerate the good feelings of selling for a gain. I found this with U.S. investors. I'm putting up a slide that from a more recent paper done with Taiwanese data. And the reason I put this up is because we know every trade made by every investor in Taiwan. We know every order they place. So we can look at the whole market. This was for a 5-year period. More recently, we've obtained 18 years of data. Every trade and every order by every investor, individuals and institutions. And what we found was that individuals and corporate investors and the dealers all had a strong tendency to hold on to their losers and sell their winners. What the 4 here means essentially is that if at the close of the market yesterday, an investor held 2 stocks, one for a gain and one for a loss, today he's 4 times as likely to sell the one that he owned for a gain than the one that he owns for a loss. So it's a very strong tendency in Taiwan. In the U.S., when I looked at individual investors at a discount brokerage firm, I found that the difference was about 2 to 2.5 to 1, not 4 to 1. So the effect seems to be bigger in Taiwan. Oh, wait a minute. We're going to have a quiz. Okay? We're going to have a quiz. I'm going to ask you to do something. I'm going to show you a video of people passing a basketball. There are going to be 2 teams. One team has on white T-shirts. The other team has on black T-shirts. I want you to count how many times the team with the white T-shirts passes the basketball. Now you're thinking that's pretty easy. I'm going to make it difficult because I'm going to count out loud backwards from 100 while you're trying to count how many times the team in the white T-shirts throws the basketball. Okay? Everybody ready? It's been translated? Okay. Let's go. 100, 99, 98, 97, 96, 95, 94, 93, 92, 91, 90, 89, 88, 87, 86, 85, 84, 83, 82, 81, 80, 79, 78, 77, 76, 75. Okay. Now, how many of you saw something unusual? Okay. How many of you, perhaps? I'm going to show you one more time. Don't count. Don't count. And particularly if you didn't see anything unusual, maybe you will this time. The same video. About now. All right? Can we have a show of hands? Did some of you not see the gorilla the first time? Yeah, usually about half the people don't see the gorilla the first time. Sort of interesting, isn't it? You miss a gorilla in the room. You wouldn't think that you'd miss such a thing. The point of this is human beings have limited attention. And if you focus all your attention on one thing, you're likely to miss other things. And thus, the decisions that we make, whether it's financial decisions to do with our stock portfolios or business decisions, they're likely to depend as much on where we focus our attention as they do on our preferences and our beliefs. Oftentimes, attention can be more important than what we believe. I wrote a paper with my friend Brad Barber, and we asked ourselves, how do individual investors pick stocks to buy? In the U.S., there are thousands of stocks to choose from, and nobody wants to go through thousands of choices. If I gave you a stack of papers with information about 500 stocks, and I asked you to go through all these papers and order the stocks, I like this one best, second best, third best, 300, 301, nobody would want to do that task. That's not the sort of thing human beings like to do. So what Brad and I think is that investors limit their search basically to the stocks that catch their attention. They don't do this consciously. They're not doing it on purpose. But what happens is a stock catches their attention. They see someone talk about it on the television. They read about it in the newspaper. And then they ask themselves, they say, oh, I like that stock. Or, no, I don't like that stock. But but basically attention takes the choice set from a large number to a small number. So, for example, I will pick on my friends. Suppose there are two investors, myself and Farhad, and I am a momentum investor, and he is a Graham and Dodd style value investor. What that means is he can read accounting reports and I can't. Okay? So one day, let's say that there are 12 stocks that we both notice. They're in the Wall Street Journal and maybe on the left-hand column, and I look at them and he looks at them, and I see one that, let's say he sees one he likes that has sound fundamentals, and the firm has been a little bit out of favor, but he says this is a good, solid company. And I see a stock, and it has had positive earnings surprises for 4 quarters, and I believe that what goes up, goes up. So we have different preferences, we make different choices, but attention takes the choice set from 8 or 9 or 10,000 down to 12. Okay, so attention makes a bigger difference in what we choose than our preferences. So what does that mean? Well, it means that individual investors are going to tend to be on the buy side for attention-grabbing stocks. What about selling? Most of these investors only own 3 or 4 or 5 stocks. If you own 5 stocks and you need to sell something, you can easily ask yourself, do I want to sell A, B, C, D, or E? That's not too big of a number to deal with. What about institutions? Well, institutional investors, first of all, they have more attention. They work in teams. They have all day. They're working at it all day. They're working in teams. They're more likely to use computers. So they have more attention. And also the choice set for selling is more analogous to the choice set for buying. In fact, if a fund, a hedge fund, or a mutual fund sometimes sells things they don't own, then the choice set for buying and selling are identical. So what we hypothesized when we wrote this paper is that individual investors would be on the buy side of market for attention-grabbing stocks. Now, how do you know that a stock is grabbing attention? Well, one proxy we use is abnormal trading volume. And we say, well, if a stock is trading more than it usually does, people must be paying attention to it. Not simply that they'll be trading. And so our prediction is that individuals not simply will be trading more, but that they will be placing buy orders for attention-grabbing stocks, for stocks with high abnormal trading volume. We have a small theoretical model in our paper, and it predicts that if you sort stocks from low trading volume to abnormal trading volume to high abnormal trading volume, the percent order imbalance, that's basically the number of purchases minus sales over purchases plus sales, a measure of what percentage of the trades are purchases, it's going to go up. This isn't our theory. Here's what we find at 3 different brokerage firms. This is 78,000 households at a large discount brokerage firm, 670,000 investors at a large retail firm, and about 14,500 at a small discount firm. At all of the firms, we get the same pattern. The percentage of the trades that are purchases goes up as abnormal trading volume goes up. More recently, we've looked at every trade on the New York Stock Exchange, NASDAQ, and the American Stock Exchange over an 18-year period. We use the size of the trade as a proxy for small investors and an algorithm to figure out whether it was buyer initiated. And we get a pattern like that. That is a very, very straight line for an empirical for an empirical analysis. Now, another proxy that we use for attention is the previous day's return. We basically assume that people are likely to pay attention to stocks that went down a lot or up a lot the day before, that those will grab their attention. Our theoretical model predicts something that looks like this. At the brokerage firms, we get a pretty good match to that, especially at the large discount brokerage firm, which is in blue. And when we go to the transactional data over an 18-year period, we also get a pretty good match. So it looks like attention is influencing, to a large extent, the buying decisions of investors. Okay, one last behavior that I want to discuss, and it's perhaps the most prominent behavior, which is that investors chase performance. Now, this is from a study that I did a few years ago, but there was evidence of this well before we did this study. We found that 39% of the new money going into mutual funds was going into the funds in the top 10 percentile for performance the year before. Over half the money was going into funds in the top 20%. Yet there have been study after study, academic studies and practitioner studies, that say that 1 year's performance by a money manager does not tell you much about that manager's ability. Yet investors behave as if it tells you a lot. Why? Well, I'm going to explain why I think this happens at some length. First of all, I think it's because in other areas of behavior, you do get more persistence. For example, this was from the Beijing Olympics in 2008. This is the final of the men's 100 meters. And who's out front here? Bolt, Usain Bolt, right? Okay. 4 years later in London, who's out front? Usain Bolt. Okay? Very persistent. In sports, we find that if someone is a very good athlete one day, they're probably a very good athlete the next day. If we were to all go out and find a 400-meter track and race around it, there would be some winners, not me, and there would be some people in the back. And if we were then a year later to race around the track, to a large extent, the same people would be in the front and the same people in the back, because athletic performance is fairly persistent. Now, there are other areas of endeavor that aren't like that. Here we have some people at a roulette table. This guy with a cigar and a white beard has a lot of chips. Tonight, if we come back and he plays next week or next year, maybe he wins, maybe he loses. How he does tonight tells us nothing. Okay? I want to tell a hypothetical story to sort of get deeper into why investors are chasing performance. This is a hypothetical story. That means it didn't really happen. Okay? And it's a hypothetical story about the time that Oren Erdem and I went to the Amazon rainforest. You know, he's an adventurous fellow, and I like a good adventure. And we went to the Amazon rainforest. Okay? And we were too adventurous, and we got separated from our group. And we looked around ourselves. We had water filters. We didn't have any food. We weren't hurt. We had a radio, and the group leader said, "I'll pick you guys up tomorrow morning on the way back down the river." So we looked around ourselves and we saw a lot of plants that we didn't recognize. I chose to eat some of these plants up here, and Oren ate some of these dark plants back here, and I don't know if he just knows more about botany than I do or if he's lucky. But he felt good, and I got sick. And I felt very bad. The next morning, I woke up. I'd recovered my appetite. What did I eat? Or more importantly, what didn't I eat? I didn't eat the food that made me sick the day before. Simple enough. Okay? Now, 2 weeks later, we are in the U.S. We're in the mood to celebrate. We had an adventure in the Amazon rainforest. We go to Las Vegas to celebrate. Okay? And there we are in Las Vegas, and we go straight to the roulette wheel. Oren puts his money on the red. I put my money on the black. And the little ball lands on the red. He wins, I lose. Next time I bet, it doesn't matter if I bet on the red or the black, does it? So what's going on here? We have two situations in which Oren made one decision, I made a different decision. His turned out well, mine turned out badly. Yet in one case, the outcome dramatically affects my future behavior. In the other case, it doesn't affect my future behavior at all. That's because I'm learning, and I'm learning by induction, by observation. But I'm also learning by deduction. And I'm deducing whether I'm dealing with a deterministic event or a random event. And if a food makes you sick one day, it's likely to make you sick the next day. And if you can't figure that out with your brain, the rest of your body will tell you. Your body just says, don't want to eat that. And yet where the little ball lands on the roulette wheel has no effect on where it's going to land the next time. So a question that sort of faces everyone in markets is where on the continuum from completely deterministic to completely random does the market lie? And I've already told you I don't believe that markets are completely efficient. And there is a predictable quality in markets, but there is also a lot of randomness. And I think many investors underestimate how random the market is. And they expect patterns to repeat themselves. And they expect that the asset class that went up last year is going to go up this year. And that the stock that went up last year is going to go up this year. And the manager who made money last year is going to go up, is going to make money again this year. They expect patterns to repeat themselves. And human beings in general expect patterns to repeat themselves. You know, evolutionary psychologists tell us that a lot of our psychological development probably goes back to hunter-gatherer times. And I'm sure some of it precedes hunter-gatherer times. But I'm going to tell one more story, and this is set in hunter-gatherer times. Two hunters go out hunting one day, and they're about to go around a big boulder, and they hear a roar. And one of the hunters goes around the boulder, and he gets killed by a tiger. A couple of weeks later, the surviving hunter, the other hunter runs away. Right? Simple enough. He runs away. A couple of weeks later, the surviving hunter goes out hunting, alas, by himself. And he's about to go around a boulder, and he hears a roar. And he thinks to himself, roar, tiger. And he turns and runs. Now, do we have any statisticians here? Some. I'm sure anyone who studied statistics knows that a sample of one is not statistically significant. The man should have tested the hypothesis. But no, he chose to run and tell the story. Okay, now let's say our hunter one day, he snares a rabbit, and he and his friends, his family, eat the rabbit in the evening, and all that's left is one rabbit's leg. The next day he goes out hunting, and he takes the rabbit's leg with him for something to eat, for lunch. He has a very good day. He kills a small antelope and brings it back to camp, and he's proud and he's happy. And all that's left of the rabbit's leg is now the rabbit's foot. And he puts the rabbit's foot on a leather thong and hangs it around his neck and says, "This is my lucky rabbit's foot. It brings me luck when I hunt." Now, we're all thinking, oh, come on. That is superstition. There's no causality there. A A rabbit's foot can't help you when you're hunting. But what was the downside? What was the disadvantage of thinking like that? What was the disadvantage of seeing this pattern that wasn't a real pattern? Not much. Thing weighs a couple of grams. He burns off maybe an odd calorie wearing it. It looks kind of attractive. There wasn't a lot of disadvantage in the environment in which we developed. It was more important to see patterns that were real, even if it meant seeing a few patterns that weren't real. For investors in modern markets, it's very expensive to see patterns that aren't real and to trade on those patterns. Okay, just a couple brief more points about investors. I did a study where we found investors tended to pay attention to load fees, to fees for mutual funds that they had to pay at the beginning. And what are we graphing here? We have no load funds, and then low load, middle load, large load, and how much new money is coming into those funds relative to the size of the fund. So there was some effect where the lower load funds had more money coming in. But what was very interesting is when we looked at ongoing expenses that mutual funds charge, monthly expenses, the higher the fees the fund charged, the more money came in. Probably because they were using these fees for marketing. So the marketing was working. And basically what we think was going on to some extent is that investors are sensitive to the fees that they are aware of, that are salient, but fees that aren't so clear, they don't notice and they don't pay as much attention to. Okay, why should it matter? Why should you care about investor behavior, about that investors are making some mistakes? Well, I care because I care about investor welfare. I would like to see investors make better long-term decisions. I did a study, again, in Taiwan. We have access to this very complete Taiwanese data. And we asked a very simple question. We said, how much money are individual investors losing or making, but we thought probably losing, by trading with institutions? So we treated the individuals as if it was one big group, and the institutions as if they were one big group. And what we found was that on the average day, institutions made about 178 million new Taiwanese dollars. There were about 30 new Taiwanese dollars to the US dollar in this period, through trading profits with individuals. And what I mean by that is that if an individual bought stock A from an institution and sold stock B to an institution, over the next 6 months, the stock the individual sold did better than the one that he bought. And we measured by how much, because we knew all of the transaction prices. Market timing. The institutions made money off market timing. When institutions as a group put money in the market tended to do better over the next 6 months to a year. When individuals put more money in, the market tended to perform not as well. Commissions. We just added up the commissions. Why are the commissions so much higher for individuals? Well, during our sample period, individuals accounted for 89% of the trading activity in Taiwan. So many of the trades were from one individual to another. Those trades don't affect these numbers, but they do increase the commissions. Taiwan charges a transactions tax of 30 basis points to the seller, so we calculated the transactions tax. And when you add it all up, the individuals, counting the commissions, counting the transactions taxes, we're losing about 670 million new Taiwanese dollars a day through their trading activity. That's about 2% of GDP. So it was a pretty significant amount. It reduced the return in the aggregate portfolio of individual investors by about 3.8 percentage points a year. Institutions, on the other hand, we're generating an alpha, an excess performance of about 1.5 percentage points after fees. And about 46% of the individual investors' gross daily losses were to foreign institutional investors. Now, last topic, or second to last, one last thing about this. How do the individuals in Taiwan. How do the investors in Taiwan differ from those in the U.S.? And then you can ask yourselves how they differ from those investors in Turkey, about which you know more than I do. Taiwan investors trade more actively than the U.S. investors. And that runs up their commissions and their transactions costs. However, there is some safety because when a Taiwan individual investor places a trade, the counterparty, the other person, that buying or selling from them is probably another individual investor. So the asymmetric information risk, the risk that you're trading with someone who knows more than you, is lower in Taiwan. In the U.S., the individuals don't trade as much. However, when an individual places a trade in the U.S., probably the other side of that trade is an institutional investor. So the U.S. investors face more asymmetric information risk. And when in our sample, and this, unlike the Taiwan study, my study in the U.S. was just for one very large discount brokerage firm. And we estimated that trading was costing the investors about 1.9 to 2%, about half of what it was costing the investors in Taiwan. Okay, what can investors do? How many of you have ever seen the television show Seinfeld? All right. I'm going to show you just a very brief clip from Seinfeld where my question is, if the stocks you buy tend to always do worse than the ones you sell, or usually do worse than the ones you sell, what should you do? Well, this is one solution.
If every instinct you have is wrong, then the opposite would have to be right.
Yes. I will do the opposite.
All right, so George decides that since everything he does goes wrong, from now on he's going to do the opposite. And that works out pretty well for George, but I'm not recommending that for investors. Okay? The advice I would give investors, which is the advice that probably 99% of financial advisors and financial economists would give, is pretty generic. Take a long horizon. Think long term. Buy and hold. Most people, not everyone, but most people shouldn't be churning their accounts constantly. Diversify. Hold a well-diversified portfolio. Pay attention to your trading costs. Pay attention to your taxes. Just basically, it's generic. It's simple, but it is what most people in the financial advice industry. It's the same advice that everyone gives. Now, I wanted to end with something that you might find interesting. I'm going to show you some of the advertising that brokerage firms use in the U.S. Now, many of these ads are from the late 90s, early 2000s. So the very last ad I'll show you is much more recent. It was played a couple of years ago, and ads like it still play today. Okay. A number of these ads emphasize the idea of control. Here's one where it says, you are the CEO of your life. Think about it. Your life is like a business. It makes sense that you are the one in charge, and that's why we make it easy to buy and sell stocks. Now, what does this woman want control over? Probably she wants control over her retirement wealth. She wants to know she'll have enough money to send her child to college. What does she get control over? Well, she gets to decide which stock she buys or sells. But that's not really what she wants to control. Right? It's sort of, I would let anyone in this room choose the stocks in my portfolio if I could choose the return they earn. That's the thing she cares about. This is kind of like going to Las Vegas, and there's a big sign over the roulette wheel that says, you're the one in charge. And when you get to the roulette wheel, they say, yeah, you get to pick your number. We spin the wheel. That's not the control you want. And then this next ad, this is my favorite control ad. This sweet young woman says, I don't want to just beat the market. I want to wrestle its scrawny little body to the ground and make it beg for mercy. If she were talking about a roulette wheel, we'd recommend psychiatric care. All right. Let's see. What else do I have here? Anybody can do it. This is a common theme. Chimp beats Wall Street wizard for second straight year. And you're worried about investing on your own? Come on. Or when we say anybody can invest online, we mean anybody. Now, take a good look at him. I think you're about to see his cousin.
You read Barron's?
Oh, yeah. All the time. That's the one where they rate all the online brokers. I use Discover Brokerage. They've been Barron's top pick for like the last 3 years.
You invest online?
Oh, yeah. Big time. Well, the last few years anyway. I'm retired now.
You're retired?
Oh, I don't need to do this. I just, like helping people.
Vacation spot?
Actually, it's a picture of my house.
That's an island.
Well, technically, it's a country. Weird thing about owning your own country, though. You gotta name it.
All right. So this is the story of the truck driver who bought his own country. And this is a very typical sort of ad along the lines of the message is you don't have to be a businessman in a suit and tie to trade stocks. So the businessman here, at first he's a little like, oh yeah, right, you trade. But if you think about it, whose BMW broke down in the middle of nowhere? It's the businessman. It's the truck driver who's out helping people just because he likes helping people. So it's a pretty common theme. Another theme is that opportunities arise at any moment. For example,
at Gene Enterprises, we've harnessed the power of the human gene so you can say goodbye to your allergies forever with new Nozula. Nozula may cause the following symptoms: itchy rashes, full body hair loss, projectile vomiting, gigantic eyeball, the condition known as hot dog fingers, children born with the head of a golden retriever, seeing the dead, bone liquefaction, possession by the Prince of Darkness, detailed growth, elderly pregnancy, back.
All right. The idea here is you could be a guy sitting in the dark in the afternoon on the couch watching television. You should be ready to trade. Opportunities arise at any moment. Okay, I'm going to show a couple more ads. The next one isn't so funny, but it's very interesting.
Well, she said shut up to me last night at the dinner table.
The market's closing.
Oh, no, it doesn't close till 9:30.
No, not that market. Let's get a move on. Come on.
Okay, here I come.
Darren, Sharon, clear out. Mama's got a trade. Ameritrade.com. And logging in. Great. Let me see what the market's doing today. Wow, market's up.
Woo-woo.
Yes.
Wonderful. Whoa. Isn't he
Settle
cute?
down. He's very gifted. And I just want to track this little biotech company that I've been looking at.
Scientific.
Okay. I've got to sell.
Right now, you're going to sell it just like that?
Done.
Oh, just like
I think
that.
I just made about $1,700.
Yeah! Way to go, Mom. But that must have cost you a lot of money.
$8 a trade.
No.
Yes,
Get out of
I'm
here.
serious.
$8. Do you know something about me that I've never told you?
What's that?
I have mutual funds.
All right. So we got two people here, the neighbor and Mom. You might have missed it, but the first thing the neighbor says is that her children talked back to her at the dinner table last night. They weren't behaving themselves. Mom says the market's closing. The neighbor thinks it's the supermarket, but of course it's the stock market. They go back to Mom's house. She brushes her kids off the computer, makes $1,700 trading an undiversified portfolio of risky stocks, some little biotech company she's been following. Meanwhile, what are her kids doing? Boom, boom, shooting off these toy rifles with projectiles. The neighbor woman is ducking. One of these things bounces off Mom's head. She does not flinch. This woman is in control in a hostile, male-dominated environment. In a war-like environment, she is fine. So, what about the neighbor? What does the neighbor invest in? Mutual funds. The woman who is intimidated by children and toys invests in mutual funds. So it's, I think, a very bad message in this particular ad. The next ad is, I've got two more and then we're done. Well, you can see. We have a punk investor here.
Stuart, can I see you in my office, please?
That kid is sick. That hinge is squeaky. Very sick.
Stuart, get in here.
Sure thing, Mr. P.
Stuart, I just opened my Ameritrade account.
Let's light this candle. Let's go to Ameritrade.com. It's easier than falling in love. What do you feel like buying today, Mr. P?
Kmart.
So research it. All this stuff is provided for you free of charge.
No cost.
Yeah, that's synonymous with free.
Looks like a good stock.
Let's buy.
Let's buy 100 shares.
All right, click it in there.
Okay.
How about 500?
100, Stuart.
Feel the excitement? You're about to buy a stock
Okay.
online.
Oh! Fabulous. I'm thrilled. What did that cost me?
$8, my man.
Mike Broker charges me $200 for this.
Riding the wave of the future, my man. I gotta get a soda.
All right.
I'm sorry, Mr. P. I'm having a party on Saturday night. If you really want to go,
I'm going to try and get there. Thank you, Stuart.
trading.
Thank you.
Rock on.
All right, Stuart. Call to.
All right, this is another ad along the lines of, you don't have to be the businessman in the suit. Mr. P, the boss, is learning from Stuart. A lot goes on this ad. Mr. P places his first online trade. He feels young again. He's excited. He gets invited to a party. He's thinking of going to the party. What I liked about this ad was that Mr. P did some research. Now, he didn't do a lot of research. Did anyone notice what he bought? Kmart. Let's see where Kmart was the day this ad first played. Kmart was right there. Kmart then went down and it went bankrupt. And the original shareholders, such as Mr. P, lost all their money. So Mr. P is probably happy today that he didn't let Stuart talk him into buying 500 shares. All right, one last ad, and this is a more recent ad. In fact, this series of ads is still running. This one ran at a first ran at a Super Bowl game a couple of years ago, and it's part of a series that's still running. And the idea is still anyone can do it.
A lot of people are like, aren't you too young to invest in the markets? And, A, don't worry about it. I just look young. I mean, you don't know how old I am. And B, I use E-Trade, so check it. Click. I just bought stock. You just saw me buy stock. No big deal. I mean, if I can do it, you can do it. Whoa.
Yep, if I can do it, you can do it. Anyone can do it. I was in Norway a few months ago, and when I was there, I was told that the Norwegians have a saying that when taxi cab drivers start giving you investment advice, watch out. So I've got a little bit of bad news for you. About 40 years ago, I was a New York cab driver. So you've been getting your advice from the wrong place. Thank you very much. Should we stop, or do you want?
If you have any questions, maybe
yeah.
Just spend 10 minutes.
Yeah, and if you need to go, feel free. I know I went over a little bit.
It's shouldn't be forbidden because it works for overconfidence. People are overconfident, and these ads make it worse.
The ads make it, yeah.
Yes.
No, I agree.
But,
yeah. These ads
should be forbidden. But
yeah. I don't think these ads send a socially beneficial message. Yes, they encourage people to do things that maybe are not in their best interest. I think that, especially the ad with the two mothers, the two women, most people should be holding mutual funds. It's fine for some people to trade, but a lot of people, mutual funds would be an appropriate decision. Yeah. I agree.
I forgot.
No worries. Please. Yeah.
academics like the effect of culture, or those kind of things? Do you think there are different factors like these?
Sure. There are cultural differences, and there are probably, to some extent, experiential differences for whole cohorts. So cultural differences. I'll tell you an example I didn't mention today. The Chinese like to gamble. It's well known. We took a look in Taiwan at trading volume on the Taiwan Stock Exchange when Taiwan started a national lottery. And we found that when the national lottery began, controlling for all sorts of the usual things, that trading volume on the stock exchange dropped 25%. So clearly, the stock exchange for many people was a form of gambling and entertainment. And some of those people said, well, I think I'll gamble and get entertained in the lottery instead of in the stock market. So I do think there are cultural differences. I think there's a learning difference, too. If you look in India, new market, a lot of trading. Mainland China, the trading volume has been really, really high. There's a period probably over which a large group of investors learns, often perhaps painfully, how to deal with markets. I mean, the U.S. investors, not that they don't make mistakes, but they do have a longer history of experience. It's more likely that a child growing up can learn something about market investing from a parent than would be the case in China.
But I remember your results when you compare the results of the U.S. and Taiwan. I think, if I remember it correctly, you mentioned that there's more information asymmetry in U.S.
Well, yeah, but I'm assuming that because the U.S. individuals represent a lower percentage of the trading volume, it's more likely their trades get matched to an institution. And I'm basically assuming, but I think there's good evidence for it, that institutions on average have better information than the individuals. So that would be the asymmetric information.
Also, a general question related to the field of behavioral finance in general. As I remember correctly, I think Peter Bernstein, in his book in Against the Gods, he mentioned the behavioral finance academicians especially as the theory police. Do you remember that term?
The theory police. I don't remember. I've talked to Peter a few times. I understand.
Basically, they say that you're catching some anomalies or those kind of stuff, and you're not producing anything general, anything useful, like Gene Fama's efficient markets theory. So what do you think about that?
Okay. The useful, I don't think we should stipulate that was a useful theory. Okay, so Peter wrote that book when? It's a long time ago, right? It's about 10 years ago, and a lot of it was devoted to things like long-term capital and to the portfolio insurance and things like that. I'm not sure that Peter would still say today that we hadn't produced anything useful. When I've spoken with him, he seems to rather like what we're doing. Okay. I think you had a question here, and then we'll go up there. But it's easy to pass the microphone that far, huh?
Great talk. Thank you very much. It's a pleasure to have you here. You are being an icon for me because I cite you in my papers. So I
appreciate that.
It's good to see you in person. But my question is about your current research. Can you briefly summarize what you are doing, what you are working on currently, and also the direction of behavioral finance for the future? The direction of the behavioral finance. Okay. What are the research areas?
Right. Well,
thanks.
I think my crystal ball isn't that clear. It's kind of like when people ask me, I sometimes get reporters that say, what's the market going to do? And I generally say, I think it's either going to go up or down. It's easier to answer a question about my own research. I've got a lot of projects going on. I can briefly tell you about one. It's the first experimental paper I ever wrote. So I've been interested in experimental economics for many years. And I don't know if there are assistant professors and students here, but when I was a student, I was planning, I had written a theory paper and an empirical paper, and I was about to do an experimental paper. And I was talking to a friend of mine, Richard Thaler, who teaches at the University of Chicago. And Richard, Dick said to me, he said, no. Write another empirical paper using your data set. Wait till you have a job to do experiments. And then he paused and said, on second thought, wait till you have tenure. But finally I'm writing a experimental paper. And the paper is about bubbles and emotions. So there's a long literature where in experimental markets you can get asset pricing bubbles. The literature starts with Vernon Smith, also a Nobel Prize recipient. And we take his very well-studied framework and we make one change, which is we manipulate people's emotions in a short-term basis by showing them videos that are either very exciting or somewhat boring. And, there's the usual cover stories and stuff. But what we find is that after watching an exciting video with a chase scene, we tend to get much larger bubbles in the experimental market. And what I'm interested in a way, is how your emotional state affects decision-making, particularly around investing. And I think that one thing that goes on is that when people get excited about the market, they're less critical, they take a little bit more risk, and they tend to use heuristics more. They tend to project what's happened recently and say, oh, this is what's happening, rather than step back and say, well, this might be what's going to happen or something else will. Anyway, I'll save some of my other research and not tell you about it in hopes I get invited back sometime, and so I can have something else to talk about. Sure.
Now, we know that frequent traders in general lose. Okay? If you trade frequently, then it's highly probable that you will lose. This is true for individuals, or this is true for human beings. How about high-frequency traders?
Different story.
Algorithms.
Different story. Renaissance, for example, Jim Simon's hedge fund that does high-frequency trading, he didn't become a billionaire by accident.
Okay,
no. So there's a very big difference between someone, he's been doing high-frequency trading since the mid-'70s. He's hired, dozens of mathematics PhDs. They study, they look for an edge. They have a well-articulated strategy that is a high-frequency strategy, and they're making money. So what I'm saying about individuals does not apply to institutional investors who have done a lot of, who are doing this sort of high-frequency trading.
If I understood correctly, you are talking about the specific institutional investors like Renaissance, you say. Well, how about the whole sample? I mean, is there a research about the whole sample of algo traders or high-frequency traders?
I haven't. I have not seen such research. There have been some recent studies on hedge funds, but it's very difficult to get the data that you need. I had a hard time originally getting data on individuals. It took me 11 months to get my first data set. Since then, it's gotten easier, and there are Taiwan. I know that the Taiwan Stock Exchange, a couple of the Chinese exchanges, the National Stock Exchange in India, all of the Scandinavian exchanges have made data available, and then brokerage firms in Germany and in many other countries, Amsterdam. So a lot of data has become available in the last 15 years, and now Odean is working with data from the Istanbul exchange. So data on individual investors went from nothing. There were no studies being done. There had been one study done in the mid-'80s with a very small sample. And now we have a lot of data on individuals. We actually have less data on the institutional investors. And it takes data to answer those questions. And the only reason I don't know anyone who has studied Renaissance. I just know that Mr. Simon has billions of dollars and I don't. So,
Hello.
Oh, we have a question back there.
Thank you for your valuable presentation. It was nice and useful to listen to. Well, talking about all these concepts like diversification, probability, statistics, and so on, what's your view, opinion about trading on the same stocks consistently? I mean, always on the same stocks. Say, for example, in the Turkish stock market, in the banking sector, you can trade always for 5 or 6 major banks' stocks. So don't you know when to do statistics or probabilities, you know the majority of the holders of these stocks are the same, either individual or basically institutional investors. So isn't it an advantage to continue to trade on the same stocks? I mean, which is a little different than what you perhaps aiming to say us, that is diversify, and it's a kind of lottery. You never know what it happens if you... I mean, could I mention the point? I mean, I think that there's an advantage to know about the stock's behavior, to know about the stock's investors' behavior as well. So, I mean, what's your opinion about this type of trades?
Sure.
Thank you very much.
It's clear that that the advice I give for individual investors in general doesn't apply to institutional investors. So for one thing, I want to be clear that I'm not saying every institutional investor should follow this very generic diversify, buy, and hold. And I think there will be exceptions. You know, there are probably some individual investors who are able to profit through skill, but I believe it's a minority. And thus, I'm giving advice that I think is good for most people. If someone actually thinks that they can, well, it's risky. You know, just because you stick with the same company doesn't mean you will learn what you need. You know, if you stick with the same roulette wheel for a long time, it's still a roulette wheel. So you would have to be actually learning. And some people maybe they learn, they don't. We did a study in Taiwan of day traders. And we wanted to see what percentage of day traders had ability. And we estimated that about 1 to 2% of day traders were making money through skill, but they were making a lot of money. They were very good. And they probably were doing the sort of thing you were talking about. So I think it's possible but difficult. And, yeah. You have the mic, so I can...
Okay, yeah, thank you very much. After the financial crisis in the United States, do you think financial regulations will have an impact on investor behavior? Or do you have any evidence related to that?
The regulations?
Yeah, how they will impact investor behavior or do...
Right. I don't think the regulations that I've seen proposed so far will dramatically change individual investor behavior. A lot of regulations is going to try to change. Regulations are going to try to change institutional behavior, and we'll see what regulations get passed. I do think that experience of losing money affects investor behavior. That, you know, having had two very serious crises, well, especially the recent crisis was economically very serious, and the sort of crash of the dot-com bubble caused a lot of people to lose money. I think that has changed the attitude for the current cohort of investors for a while. Not permanently and not for new people coming in, but I do think it makes a difference. And there's a colleague of mine, Ulrike Malmendier, shows that people who grew up in the Depression took less risk than people who were born, you know, after World War II, because they had this, you know, systemic bad experience. Yeah.
I remember.
Okay. So maybe we'll finish up with you just where we started, okay? And then if other people want to ask questions, you can come up and talk to me. Okay. So go ahead.
What was you said? What will we get from this behavioral finance? I am interested in it because I am working in a project for surveillance. You mentioned your paper about attention. taking stocks. When there is pump and dump manipulation, in the pump period, it takes attention. And so investors give momentum to the stock, and manipulation is possible. There are some theoretical papers that say manipulation is not possible, and some say it's possible. Once to earn $8 million in 15 seconds, I couldn't get the paper.
So I'm not sure the question. Do I think manipulation is possible? Yes. Do I think behavioral biases can contribute to it? Yes.
Yes.
Yes and yes. And I'd love to, I mean, that's something, it'd be interesting to do a study to sort of document that type of manipulation where, I mean, there have been some cases that the SEC has brought where people did manipulation on, like in chat rooms, where people would spread rumors to try to drive a price up. But I also think it's possible to do it just by taking something with sufficiently little float and getting the price moving up. I'll end with a very short little story that was told me when I used to trade stocks in Vancouver before I was an academic. And there was a story about a broker who had a client in Vancouver. In Vancouver at the time, it was a lot of very small companies, mining exploration companies, without much trading activity. And the broker, he had a client who hadn't bought or sold anything for many, many months. And so the client hadn't generated any commissions. So the broker calls up the client one day and says, I have a great idea. Let's buy Ajax Exploration Company. And the broker tells a good story, and the client says, oh, yeah, that sounds great. I'll buy 100 shares. And he buys 100 shares, and the price goes up a little bit. And then the broker calls the guy back a week later and says, well, the price is up. Maybe, I think it's still a good buy. And the client says, okay, I'll buy another 100 shares, and the price goes up. And this happens a couple of times. Then the client starts calling up the broker and saying, let's buy more. And the price keeps going up. And then one day the client calls up the broker and says, it's time to sell. And the broker says, to who? All right. Thank you very much.